All right, we are live. Welcome, everybody, and happy holidays. Thank you for hopping on with us here tonight for our third office hour, where we know that you have questions and we've got answers, hopefully, for you. So tonight, I've got two special guests with me, Tariq Sattar, CEO over here at Anthem Capital, and Mark Steele, one of our favorite lenders in the world when working with us on a number of our deals. And so the questions have come in fast and furious over the past month or so when we first announced that we were going to be covering lending and interest rate type questions. And to be cognizant of our honoring only 1 hour of an office hour, we want to hop right into it. So first, Mark, I'd like for you to be able to introduce yourself.
Absolutely. So first of all, thanks, Dan and Tariq, for giving me the opportunity. Name is Mark Steele with Meridian Capital Group. We're a debt and equity shop based out of New York, national firm with all asset classes, but myself and my team focus primarily on multifamily, everything from, land, development, value add, whether it's on the, Class A deal, whether it's with an agency, a bank, a life company, bridge that. And obviously it's an interesting time in the market, but excited to be here and try to share some wisdom and, maybe learn from some questions as well about what's happening in the lending world today.
Dan, I'll just add to that we worked on a deal together. This would be many years ago now, Mark Steele, where our backs were to the wall, that was our first bridge loan that we did. And since then, Mark has been our go-to guy for any, acquisition or refinancing that we are looking at in any market, really, that we are looking at. And that he has been very creative. We have done agency, bridge, bank, credit union. I think all of those through you.
Well, yeah, Tariq, it's too kind, but we have, and I still remember, to be honest, I don't know if I told you then, it was my first bridge loan I ever did. My team at that point was, I would say, pretty experienced in the bridge space, but I think that was probably in 2016 or so, and bridge
17, maybe 2017, late 16, early 17.
Right,
yeah.
For myself, it was the first bridge deal I had done, but from there we've done tens and tens, and done all over the country. But it was a good experience, and started a great relationship with you and Anthem, and looking towards the future.
Awesome. Well, hey, we appreciate you joining us here, Mark. We know you have some other commitments that you have to hop to here in less than an hour. So thank you again for joining us. And I'm going to kick it off real fast. I'll just pop up the deck like we've done in prior times, where people can quickly read the questions, and then we'll pop it back down so people can kind of see people's responses to it. But first, Mark, I didn't let for people to see your information in case they do want to get a hold of you.
I appreciate that.
You guys can find it here. So that's Mark, guys. If you want to call him, there's his number. And if you want to email him, there's his email. Great guy. We've enjoyed really working with him. And so let's hop to the next one. Mark, we're going to kick this off. What's going on in the market right now? You want to take
That's a loaded question. That's a question that I don't know if we can answer in 1 hour, but I will say there's a lot of movement in the market, and there's uncertainty in the market. I guess defining the question right would help me answer it better. But what's happening in the market really with regard to lending is that interest rates are moving up, and most lenders, whether they're looking at debt service coverage today, and we'll talk about that, or tomorrow, ultimately deals have to cash flow. Now, if interest rates are higher, it's more difficult, to get the cash flow needed to cover. And, where we are today, obviously, is 100 or 150 basis points higher than we were just a couple of months ago, but we're 75 basis points lower. When I say the market, I'm talking about the Treasury, and that's the benchmark for most multifamily lending, than we were a month ago. So it's really a moving target, and cap rates and everything's intertwined into that today. So it's really it's a time that you need to really look at your lending and see is this product that I'm in the right deal for now? Sometimes you could have gotten to a bridge 8 months ago and say, I've got an opportunity to get into a fixed deal, whether it's a floater to move into a fixed deal, or is this a time to sell? Is this a time to hold? Is this a time to buy? There's a lot happening in the market. I think we'll get to discuss that over the next hour or so about what's really happening specifically and how we can capture the best opportunity and the best debt for the present moment.
I will just, Dan, I'll just say that, as Mark said, there is a reset that we are experiencing real time. The pricing expectations are being adjusted. Loan sizing obviously has been impacted significantly. Loan sizing, loan terms, the lenders in the market, they are cut back. They have cut back. The number of lenders have cut back. The amounts have cut back. The private equity groups have pulled back. There are several that have just been pencils down until there is, we are through this volatile period that we are going through. And this is, we haven't experienced this kind of volatility in the interest rate markets in several decades. So a lot of the players, a lot of the participants in the market, both on the buy, sell, financing, the various parts of the capital stack, have not had the experience with this kind of liquidity. So it's just going through it and trying to get your arms around it, and how things are starting to somewhat make sense as Federal Reserve starts to slow down on the pace of increases and the statements that are coming out from the Federal Reserve as we get some more data on the inflation and the growth. So it's just real time reset that is happening, and just experiencing it ourselves.
Absolutely. No, I think that's really what it is. To sum it up, it's a reset in the market. And again, lenders also, they need to, although they could have lent at a specific, whether it's specific leverage or interest rates today, they also need to look to the future and know that the basis you're getting in is good. Plenty of deals today that were financed just a couple of months back are worth less than than you purchased them a few months back. So I think there's just, as Tariq said, it's a reset in the market. It's let's catch our breath, see what's happening. Interest rates have been moving up. You do have the Feds. The indications are that they'll probably slow down on those interest rate hikes, and we'll see how that all plays out. But if they do slow down, there'll just be confidence in the market, which will bring lenders back into the table, to the conversation, and hopefully it'll spin things back up again. But there is still going to be that question of, where cap rates are, even if rates come down. But cap rates have gotten so compressed and so low. Even if, if they're starting to move up, will they continue to move up? Will they level out where they are? Ultimately, the cap rate's got to be something that you can make money on. So you can't make money with interest rates are today. You can't make money on the cap rates of yesterday.
No, that's great. And thank you guys for handling that one. You answered it a lot better than I could have. So I appreciate your expertise there. We've got another question as a follow-up to that, and I'll pop it up here real fast so people can see it again. But the question really is, what types of loans are lenders most and least comfortable with now as these interest rates are climbing, as we are in this kind of volatile period where everything's pretty much uncertain? Is there one place, if somebody's looking to get a loan, they should structure it as versus another place?
Well, I think to answer it really simply, it's a risk thing where if you're going to buy an A- deal or a B+ asset in a growth market in Dallas, let's say, and you're going to take, 55, 60% leverage based on today's interest rates at a 125 debt service coverage, where the deal really can support the interest rate, that's what the lenders want to play. If you're going to buy yourself a vacant, shopping center in Memphis, you're going to have the least interest. And it really, as you dial it in, it's, obviously that's the wide range, but lenders want to know where they can get their money back. They're not in the real estate game. Most lenders are in the lending world. They want to give you money. Obviously, there's a risk. You're going to pay for that, and they want to get their money back, whether it's, 3 years for a bridge loan or 10 years for the agencies. They want to get their money, monthly or annually paid to them, their interest, and get the money back on the other end. So to really answer the question, it boils down to a safe investment. Multifamily, by and large, is probably, people always need to live somewhere. There's talks of, whether, right, there'll be, vacancies or not, but ultimately more people need to live somewhere than have to office or go shopping. And, multifamily in a strong growth market that has a shortage of apartments is where people is the safest place. And that's where lenders really want to be. The lenders we speak to and the deals we're showing them, those tertiary market deals are very difficult today. Outside of Fannie Mae and Freddie Mac, which will basically lend anywhere at some capacity, but when you have a multifamily deal even that's performing well, but you're in a really tertiary market with no growth, you have a much more difficult time. You're getting much less favorable, terms, not only rates, terms, than a good stabilized deal that lenders believe it's below market. So we can talk about the agencies have what's called mission, and that's low rents. And that's what they want. They want deals that people can live in and people can afford to live in. And that's where lenders will overextend themselves. And again, it's not that they're passionate about that deal. It's that they're passionate about getting their money back.
Right. It just, as Mark said, just comes down to lenders are a lot more cautious and careful where they are lending and who they are lending to. Of course, market is a key component of that. Experience of the sponsors is a key component of that. But the reality is that with the drastic change that we have experienced in the interest rate markets, in the interest rate environment, the loan sizing has been impacted unfavorably for us as borrowers across the board, whether it is an agency loan, a bank loan, a bridge loan. And there are a lot less participants in the market, so it is not as competitive. And just lower loan sizing is purely a function of higher debt service. So you just don't have, and the ratios, the hurdles that a lot of the lenders haven't changed. Maybe they have even become more conservative in some instances. So it's just lower leverage, lower loan sizing, and just translating to a more difficult environment for the deals.
Absolutely, that is the truth.
So let me take something one step further here, and I guess I technically need to pop it up so people can see it again. But I'm now putting you guys on the hot seat and predicting the future. So last week we had Pal's comments to give some idea of what to see in 2023. What do Tariq and Mark see in 2023 through your crystal ball that people should be considering?
Tariq, you want to start with that one off? Or?
Sure. So, with the recent comments that we have had, and adding to that, when you look at the history of when Fed has gone the way of raising the interest rates, how long does that last? The expectation is that at some point in 23, it is most likely towards the back half, or maybe even the back quarter of 23 going into 24, when you would see this trend shifting and maybe Fed reversing course and starting to lower the rates. A lot is going to depend on the data that we continue to get between now and then, unemployment, growth, CPI, inflation numbers. There are so many different metrics that Fed looks at, but the reality is that is all historical data that is being used to decide on the policy for the future. So that's why we end up in the recessions as we go through these transitions of going from low interest rates to high, and then we go too far because we are looking at historical data, and by the time we realize, oops, we made a mistake, we should have pulled back a little sooner, we're already into a recession. And then so it's going to depend on the data, the kind of data that comes out, the numbers that come out, the changes that happen, year over year, month over month data trends that Fed and all the economists look at. So that is really going to drive, but looking at the historical trends and historical data with reference to Federal Reserve and interest rates, they should be lowering in the second half of 23. At some point in back half of 23, we should start seeing a shift, and then continuing with that shift into 24. would we go back to the interest rate environment that we may have gotten used to in the last 18, 24 months? I don't think we get there. I think it's going to be higher than where we have experienced it, and that was just because of the pandemic and the unique times that we went through, and the fear that was there of the impact that was going to have, the pandemic was going to have. So I don't think we go that low, but we will be lower than where we are right now.
Yeah, just to add one point, I actually have some documents on my desk from a conference call a couple weeks back. I can't pull up the correct one, but just to add what Tariq said, where interest rates where they were the last year or two are unheard of, right? The interest rates where they are today is where they were prior to 2008, going back 50 years, right? The low interest rate environment that we were in started post 2008, and it's really just been this last cycle. So, although yes, the Fed's at a certain point will have to lower the Fed rate because that's significantly higher. But, the rates have to come down, but they do need to see, inflation come down. They do need to see, the data's got to be there. And, again, what you mentioned where, right, sometimes a little bit too late. I think right now, the world's starting to see that inflation is slowing down, but it's still high. It's still at 7.1% or so. It's way higher than it should be or needs to be. Or can be, and we'll watch it month over month and see how that, as that number comes down. There's obviously a lot of pressure for them to slow those rates down, but at this point, they don't see, I think the next, month or two or three or four, there'll probably be additional rate hikes, if that's my belief in the market. And obviously it's yet to be seen, but rates are still moving. Inflation is still high, but at the same time, there's still growth in the market, and there's still, to just jump here to real estate, to bring the conversation. That's obviously only one component of the economy, but there's still a shortage of apartments, and there's going to be a need. So we'll see how high rents can move before, at a certain point, people just get tapped out. So if inflation's there, and it will continue, I think rents are going to continue to go up.
So you guys mentioned one of these factors that kind of struck a chord with me, employment numbers. Because just last week or just a few days ago, the Philadelphia Reserve released that report saying, well, depending upon which labor statistics, we might have misstated by over 1 million jobs. And really, there's only 10,000 incremental jobs in Q2 versus the 1.1 million we reported. And that a higher employment number actually leads to higher interest rates. So these are all moving variables that we're catching real time that could ultimately impact these interest rates and that crystal ball that we're predicting for 2023. So it's not perfect. We've said it in prior office hours. We are making the plane as we fly it, and you just have to adjust and keep going. So thank you for that, guys. I'll move us right along to the next one, but I love the answer so far. Since Sis geared towards real estate, I want to shift in that direction of, okay, it's a high interest rate environment. People still want to try and make some money. And Warren Buffett always said, be fearful when others are greedy and be greedy when others are fearful. So there's a lot of fear in the marketplace. So if we try and flip it around that way, how are you going to be able to find good deals in this high interest rate environment if you're looking to acquire said assets?
Again, I think and that's obviously that is the question that everybody has, because transactions have slowed down and people need to transact. Ultimately, good deals will be had when maturities start coming up and people have their backs against the wall. So you got a guy that took a 3-year, bridge loan. The loan is maturing. He took 85%. He got this deal when interest rates were low. He only budgeted, to exit this deal at a 3.75 interest rate or 4% interest rate. He can't even get out of his debt. So a lot of those people are hoping, and they're waiting till the last minute. So they've got, 2 months to maturity, and they can't figure the deal out. At that point, they need to sell. There's not enough time to really fully market it. Those are the guys and those are the deals that, unfortunately for the seller, but the market is going to pick up good deals. And this is where people that know the brokers and know the sales brokers, forgetting the debt, and are just in touch with the market and know what's happening will be able to pick up good deals. The other thing is really to try to find deals that are sold at a little bit of a higher cap rate. Now, multifamily is still at lower cap rates. It has moved up a little bit. And I'm not saying anyone should switch asset classes because that comes with its own risk. But sometimes it's trying to see what there is, whether it's, how I can increase income outside of the box. Meaning, if you're going to get in and say, I'm just going to do the typical value add plan, I think that's a risky move today. But if you're going to find a deal that maybe has a high vacancy in a decent market and try to identify the problem and say, this is a pretty clean and proven, way to increase income, I think that's how you'll be able to, pick up deals at a higher cap rate and deal that works. But the other way to find good deals is if rates come down, and then, we'll be back in business.
Right. And the expectation is that, as we just talked about it, the rates should come down in the next year, 18 months time frame. But a lot would depend on the data that comes out between now and then as well. But as Mark said, the deals are being done. The volume, the pace has slowed down quite a bit. We at Anthem have acquired a couple of assets in the last 3-4 months, and we have sold a couple of assets. We closed on one just a couple of weeks ago, and we are hoping to close on one this week, a disposition, a sale that we have under contract. So, we continue to be active in the market, and these are deals that we have sold are fixed rate. We had fixed rate loans. It was not that we, had a floating rate loan on either of them and needed to sell. So we sold, but the price had to be adjusted from where, the valuations were 3, 4, 5 months ago to where we actually went under contract. And there were, adjustments post going under contract in both of those transactions. So deals will happen. Deals will happen at a slower pace, and you just got to look for opportunity. And there are find the right kind of financing and equity to go into that deal. One of our recent acquisitions that we have done in Kansas City, we actually took on a partial recourse bank loan, fixed for 5 years at 4.99%, and with a 3-2-1 prepay. And there's partial recourse, but we have taken partial recourse in prior loans, Mark, with loans that we had done through you with a credit union and with a bank, with a couple of loans with a credit union and a loan with a bank. So we depending on the opportunity, we are not averse to taking on that risk, but the opportunity has to be there, and you just have to be very cautious about it. And be very careful in the assumptions that you're making going into it, because yes, there is an expectation that the interest rates are going to come down in due time, but it depends on the data and depends on how things pan out, and things could change. No one could have predicted the last couple of years that we experienced and what we went through. So you just don't know. We can try to predict, but be cautious. The deals will be done. Transactions will happen at a lower pace, more cautious.
Absolutely. And again, just to add, and maybe it's not directly answering the question, but just to add to what you said, when deals, right, there are people that are going to have to sell. Now, the problem that's happening in the market, and Tariqa, you're more on the buying side, and you can talk about this, but is you have two kinds of owners. I mean, not only two kinds of owners, but a lot of the syndicators, although they have to sell, right, at the same time, because they may have an investment horizon, whether it's because of a maturity or just their investors want their money back, they bought these deals a short time ago, very opportunistic, and they can't necessarily get their investors back a great return. They can still get them a return, some of them it's a cash neutral, but there's they don't want to sell and they don't want to raise the cap rates because they need to do good by their investors ultimately so they can do the next deal. Then you've got the legacy owners and the person that owns the deal for 10 years. He says, you know what? I don't need to sell either. I can sell, but I'm not pressed and they're not necessarily going to sell today. If they didn't sell last year, they'll just wait another year or two. So if someone sold cap rates were 3.5% now, why would I sell it at 4.5% if I don't need to? So a lot of this is holding back, right? This lack of inventory is holding back in the market. And I think that the few deals that do pop up, you're still going to have a feeding frenzy, which will keep some, cap rates down. So it's really, it's locking in the market from really fully readjusting or resetting. But when we have those maturities and those people that are stuck, I think we'll start to see a lot more opportunities of, good deals or deals that start to make sense, and investors can go out and buy and just really reset the market at a more normalized cap rate.
All right. Well, hey, guys, I appreciate that. I guess I want to do another follow-up question as we talk through lending. And I'm sure some of the listeners or viewers also follow Pace Morby's real estate group. And Pace Morby has been all about seller financing. But Mark and Tariq, are you guys seeing any more creative forms of financing for deals going on in today's environment, whether it is that seller financing, whether it's people trying to establish lines of credit versus traditional lending, moving into partial recourse like we touched on, anything that you're seeing that might be more out of the ordinary versus a couple of years ago?
Well, again, to answer that question, yes, obviously, right? You have to get creative to make a deal work. It depends who your equity is. And there's equity that says, I just want a typical agency or bank loan that, and it's not necessarily going to be a 3-year hold like we had in the past. Those good days have moved on, for at least for the time being. The problem with seller financing is a lot of deals don't have, the sellers don't have enough equity in there necessarily to hold that much in these deals. So I'm not seeing a lot of seller financing. You are seeing it. I would say, my book of business has been, it's a national book of business, but it's primarily with syndicators and syndicated groups and, small family offices. And I haven't seen so much of that. You probably will see it more in, deals that are owned by families long-term, if they're in the, the market to sell. Taking some sort of recourse, although a lot of people are adverse to recourse today, because if the market continues in the wrong direction, I don't want to get stuck holding the bag. But taking some recourse or finding local banks, or actually, believe it or not, we've got banks, and we've seen this before, but now more, where banks want a relationship, and that's what banks are about. So people would say, I'll transfer legitimate deposits into banks. We can make things happen, have made and continue, that maybe it's not on, their tier sheet, and it's not what they're traditionally doing. Banks want relationships, and that's really where they'll do those waivers and favors and help people, in special situations on the acquisition side, and obviously on the refinance side as well. And then there's just traditionally thinking out of the box on a deal-by-deal basis. What can be done? How can things be structured? Where should we be pushing over the next 2-3 months on our deal so that the deal can work for a refinance that makes sense for us? And that's our job, and that's where we've been doing that, and we're continuing to try to think out of the box. And this is not to to toot my own horn, but I think this is where the difference of a couple of months back or a year and a half ago, it was much easier to be a mortgage broker, because yes, there's the same bunch of bridge lenders everybody went to. So although I think I can underwrite better, I may have a better relationship, smoother process, maybe yes, maybe not. Most deals could have been financed by anybody that understood the basics of the industry, right? When today, it's a different conversation. You need someone that's an expert and understands your deal, understands the sponsorship of what they are, what their goals are, what their game plan is, what they can afford to do, and what they cannot, understand the lending market. So it's about thinking out of the box, being on top of your collections. Ultimately, whether it's an acquisition or a refinance, lenders are going to look at the latest data. If you can convince them to use a T1 versus a T3, that's what we're trying to do. But you've got to be on top of your collections, make sure, and really understand your deal. If you own a deal, understand where expenses are, why specific expenses are there. And that's a job really at any time in the market for you to be. But when things are good in the market, everyone lets things slide. When things get tight, that's when you need to be very diligent about every item and every line item. And, again, mortgage brokers and bankers will work with you to try to make those deals happen.
Right, and I think what is important is your track record, your experience, and your personal balance sheet, your net worth liquidity. That matters to these lenders, and that's why they have those requirements as well. But going back to the question, Dan, that you had asked with reference to creative solutions, Mark, as you said, longer term holders. I've seen already a couple of deals where seller financing has been a part of the offering, but these are both deals that I'm talking about are deals that have been owned by a long-term owner, more than 10 years, 20
Right.
years. So these are long-term owners that have, even in today's market, even with the adjustments, have so much value there that they can afford to have some seller financing and get decent return through that financing as well for a short period of time, but they have the ability or the opportunity to do the transaction and sell it to the next buyer. And there are outside of that the lines of credit. I haven't seen that as much in the multifamily space, but banks continue to be active. Smaller regional banks continue to be active, but very much a relationship-based business. So you got to have that relationship in place for them to be able to offer some good rates, good terms to you, and as has been said so many times for the multifamily space in general, that it is an unfair business, and your relationships will give you an unfair advantage. And that is where when the times are tough that we are going through now, those relationships carry that much more weight.
Absolutely. And again, and just to add a point, we see that from the lenders that we work with. They know, right? Oftentimes, without naming a specific lender, but we had a conversation earlier this week, I believe it was Monday, with a lender that, I reached out to a lender about a refinance of a deal for, it was a refinance from a different lender to bring it to this lender. And I sent in the package, and it had a borrower's name in it. And they mentioned to me that borrower has a deal that is not in trouble, but he has a bridge loan with that lender, and they continuously track the deals, and it's doing worse than it should. So they're still going to quote it, but they're not going for any, as I said, they're not going for any waivers. They're not going to they're going to run this the most traditional route, and hopefully we'll be able to make a deal happen. But having a relationship and having a lender that knows you, more often than that, will help you, strongly when you try to refinance or try to transact in the market.
Oh, thank you for that, guys. I mean, so these opening first 5 or so questions, whatever we just covered there, has been really high level and very sophisticated, and I love those responses. I know not every person that has registered for this office hour has that high level of sophistication. So we have some other questions that have come through that I'm going to transition us into that might be more elementary, and maybe we lay out the foundation there and then give it also that advanced tier 2 type knowledge too. If you guys can voice that over too. So I'm shifting us now in this back half really towards more what we'll just call the rapid fire questions. And if we don't get through all of these, don't worry. The people that sent over the questions will respond back personally to you. So here's kind of a softball one, but it's a question that people are starting to see as they see these multifamily deals that are either a full-on development or they're already stabilized. And so they're seeing these differences between an LTC or loan to cost and an LTV, loan to value. What's really that difference? When do you see those? Who can best answer that?
Okay. So, I mean, to kick it off, right? The basic definition of loan to value is what the loan is of the current value. So if you're buying a property for $10 million, assuming that you're buying it at the value, and generally if you're buying it, you are the comp, you are the person that's saying it's worth 10 million. So 70% of that would be $7 million. A loan to cost is the lender's looking at it and saying, what is the total cost? And I'm going to lend you a specific amount of the cost. So again, if you're buying it for 10 million, you're going to implement $2 million of CapEx. Now your total cost is 12 million. 70% of that is a 8.4 million. Thank you. Yes, 8.4 million. So 70% of that. Now, a lot of lenders are going to say, I'll give you 70% of cost, right? Let's just use the same numbers. You got $12 million loan, 70% is 8.4. I will give you 70% of cost as long as it does not exceed 85% of value today. And that isn't often a metric, and that metric is actually coming down more today, where they're saying, although I will give you some future value, some dollars towards future value, because loan to cost metric is really used where I'm saying I'm going to implement those $2 million, put those $2 million into the property, but the property will be worth $14 million, right, tomorrow. So they may stip you on today's numbers at where it's a loan to value and loan to cost, and lenders may say, and this often we see, again, using those same numbers, I'll give you 70% of cost, which is 8.4, as long as it's less than 85% of value, which essentially 8.4 is less than 8.5. That's really where loan to value and loan to cost come in. You know, as an owner, right, your loan to value is what you believe the value is today, and your cost is really looking at, I guess, Tariq, you'll answer that, is what my total cost is, and I need to know that I can get a return based on my total cost. Because although I may have a cap rate today based on my purchase price, that I really need to factor everything in to know what I'm spending on this deal, and then I can really know what my cap rate is, what my returns are on my full capital stack.
Right, and you know, when you say loan to cost, as a sponsor, as a buyer, I need to take into account, in addition to what I'm paying for the property and what my rehab or capex plan is, what I'm spending to improve the property, I have closing costs that could be significant in today's market, and I have, you know, some working capital that I'm going to need to get the process going from the beginning. And on top of all that, when I'm, you know, if the lender is funding some portion of the rehab dollars, then, you know, for me to be able to get the lender to pay me those dollars for rehab, I need to do the work. I need to spend the money first, pay the vendors, get lien releases from them before I can submit to the lender for those funds. So I as a sponsor need to make sure that I am accounting for all of those different buckets of capital that I'm going to need to run the property, to manage the asset once I close on the acquisition. So I have to take all of those costs into account, and that, you know, some lenders, bridge lenders, oftentimes will take all of those different buckets into account, but the reality is that the leverage has been coming down as the interest rates have been going up because the debt service cost has gone up so much. So, and then, you know, the other thing is on the loan to value side of it, what you are buying it for is really what is defining the value. But, you know, the appraisal needs to justify that. And that is something that happens once you initiate the process with the lender. There's a third party appraisal that happens, and, you know, in recent years, the appraisals have been pretty good. If you have someone working on your behalf in the middle as your loan broker, and Mark has helped us in this space multiple times, where, you know, an appraiser is going to make assumptions on the expenses, on the taxes, and where the value is going to be. And if that appraisal comes in different, or the taxes come in significantly higher in the appraisal that is submitted to the lender, you could see your loan dollars get cut significantly, you know, a few days before the closing. So those things are real and need to be managed along the process, along the way. But loan to value is more, you know, on the agency side. But loan to cost could be on the bridge side, and the costs, especially the closing costs, could be significant if it is a floating rate loan and you are required to buy a rate cap. Rate caps, depending on the spread, the strike of where you're going in rate is versus where the rate cap comes into picture, comes into money, and starts, and your interest rate essentially is capped. how big that margin, big that gap is going to define the price. But a year ago we closed on a deal where we paid 100,000 for a rate cap that is priced at over $1 million today for the same delta, and that is purely a function of the volatility in the market. And if you are required to buy that interest rate cap by the lender, that is part of your closing costs. So your loan to cost gets impacted by the various costs and the various buckets, various numbers, various line items that make up that number.
Absolutely. Absolutely. But yeah, again, and that's really, the value, as you said, right? Loan to value is a very easy metric, on a purchase, just going back a year ago. Where appraisers, again, values continue to move. So on one hand, you need to be able to prove to them that this property is worth 10 million when property with similar vintage, similar size, only sold for 9.5 a month before, because we can show this is the comp, this is what I'm willing to pay for it based on how I look at this deal and what I plan on doing to this deal. But today, appraisers are really digging in deeper and trying to justify the price. And they're looking back and they're seeing prices decline. And they need to know, what? Something sold at X yesterday, today may be worth less because, other factors in the market. So loan to value and the cost aspect is obviously whatever you're going to spend. It's $1 and cents. But the value part about it has become very crucial in the conversation today and really has to be worked on, from day one. Buyers need to really be prudent about insurance and, I don't know, right? And I don't need to talk about that. We see where insurance is going and taxes, but even other expenses. There's always been just this, easy budget of, I can knock payroll down. I can, G&A is simple. Oh, repairs and maintenance. This property is a beauty. It's a 1960 flat roof with chillers, but I've got, I'm going to budget $400 a unit for repairs and maintenance. Those numbers worked, as we said earlier, because the times were good. Right now, we really need to, again, it's our job to be able to squeeze the lender as much as possible and try to build a case. And sometimes that's finding other properties you own or other properties the management company may manage or other deals we've done in the market to prove out a story. But ultimately, as an owner, you need to know your deal because the budget I'm going to convince the lender to use is what the lender understands they can operate the property at. But at the same time, if you want to be able to get in and build this property, move it to greater heights and be able to make money for your investors, you're going to have to spend money there. And some of that's in expenses as well.
Right. And those expenses, on the rehab side, the payroll you mentioned, that is, inflation plays into it. Those payroll used to be, depending on the market, 900,000, 1,100 a door a year. We are looking at numbers 13, 14, 1,500 a door a year. The repairs and maintenance numbers are much higher just because the material costs are so much higher, the labor costs are so much higher. And then the rehab, a couple of years ago, $5,000 to $7,000 could get a lot done. But now some of the more recent rehabs are double or triple that, depending on the scope of what you are doing. You could be spending, somewhere between $15,000, $20,000, even more $1,000 on rehab of an apartment, and that becomes, that is significant. That is a large amount of money, and is there return, that is justified for you to spend that kind of money and be able to get a higher rent? So, those things are going to be questioned and looked at very closely now when you go to a lender with those assumptions.
Correct. Absolutely. Right. The $900 unit payroll, is hard to justify today. Forget even going to a lender. As an owner, you've got to be able to operate a property at a certain level, and if people are living there and you want to be able to push rents, they've got to be fully staffed, and people need to know that when something has to get repaired, it's done right away. Again, there's got to be office staff, and payroll costs are just one of those factors. And there's, the entire expense column, every line item has gone up and continues to move up. And rents are continuing to move, but you've got to know, where your expenses are, and that will help dictate your value, right? The NOIs, you cut $100,000 in NOI, right? You're cutting, right, a couple $100,000 in value. So that's really something that has to, be looked at properly and understand well.
Yeah, I mean, I was just thinking back. Mark, you even know about this too, and Tariq, you've certainly been a big help on this. We've been underwriting some deals in some markets that have some major rehab needs, and a few years ago, like we said, $7,000. We're underwriting at $50,000 a unit to do these things. It's absolutely absurd. And yeah, shipping container costs have dropped and should drop, and the inventory coming online and Q1 of 2023 should hopefully drop some of those material items that have seen such a big spike in 2022. But still, it is driving those costs up, and we want to be conservative in our underwriting. Let me. We've only got 12 minutes left. I want to switch to another one here. It's more elementary, but you guys are doing a great job then taking it to the next level. Let's start with, what does DSCR mean? And what is it projected to be? And like, why is that important? And like, Mark, as I think about it from a lending perspective, we've got the various types of loans people could receive. What is the minimum DSCR that a group, a lending group, would consider in order to actually make that loan? Or are then interest reserves required, or just kind of walk us through it there?
Absolutely. So I think the first, the reason why DSCR is such an important metric, because value and all those things are nice, what you're paying for something. And a basis is an important thing on a deal. But at the same time, if you're going to take out a mortgage, you need to pay the mortgage back every single month, the cost of it. So your debt service coverage ratio is debt service coverage ratio, the ratio above your debt service that you've got. Means if you've got a $125,000 of free cash flow, right, after this, prior to debt service, property related, you should be able to take out, most lenders, a 125 debt service coverage would mean you can take out debt that will cost you $100,000 a year annually. And that's really, the simple, nuts and bolts of it. Ultimately, there are lenders that will go to a 115, 120. There are lenders that want to be at a 130 or 140. And it goes back to, a risk kind of thing, right? If you go out with the agencies to some very tertiary markets, they're going to be at a 130, 135, 140 debt service coverage, again, using, right, just it needs more coverage. Better markets, the agencies are pretty, stiff at times. They've got to 120, but just in the banking world, you're anywhere from, 120 to 130 debt service coverage in the stabilized market. HUD deals actually will go to a 118 debt service coverage. And that's, that helps your cash flow, because you can essentially get, you can get more, right, more dollars here. While on the bridge market and the bridge world, they're much more opportunistic. And that's essentially what the definition of a bridge. I'm taking you from point A to point B. It's not about today. So they will look much more towards the future. And I would say the vast majority of bridge lenders historically, but definitely today, want you to be at a minimum at a 1.0 debt service coverage, meaning that although you may not be able to put any money in your pocket, and they'll look at it more on an IO basis versus on the constant, what the actual interest rate and the amortization is. What can this property support? Means how much, if I'm borrowing at 5% interest, what can I borrow that will cover, that the cash flow here today will cover my debt payments? There are lenders that will go down, there are people that finance vacant deals that have no cash flow. But the typical multifamily bridge lenders for the value add want to be at a 1.0. Stabilized lenders want to be between a 120 and 130 on the debt service coverage ratio. And that's the coverage that you can get that the property supports.
Right. And on the bridge side, the days of when lenders were very aggressive are gone, but you can still get good, leverage, good debt, lower debt cover with a bridge deal. But as it gets closer to one, or there are, lenders that would fund it, give you a loan at a debt cover below that as well. But they may, as you mentioned earlier, Dan, that they may require you to have a reserve an account that has cash in it for the first year or 2 years of interest payments, to make sure that the lender gets paid and that money is set aside going into it. So that is important if you go, on a lower debt cover, then the lender may require that. And then, a lot of these bridge lenders may have, triggering lock boxes where, if there is a covenant that is violated, or if certain hurdles, certain covenants get triggered, then the lender steps in and takes control of the cash. And that can be very difficult. And in the last couple of years, there are a lot of deals that have gotten done that have these lockbox arrangements in place. The accounts are set up, and God forbid the cash flow there drops for whatever reason. The debt service, of course, is higher. If the cash flow drops, and some of those hurdles, that triggers that may have been put into loan documents in a different interest rate environment get triggered, the lender takes control of the cash. And those are situations that you want to avoid at all costs.
Absolutely. And again, and as an owner, although again, it's still your deal, but they're going to take all the cash and they're going to pay out, the NOI, and then they're going to get paid before your asset management fee. So essentially, if values don't move up and you're not even getting an asset management fee, you're working for free just because you have your name on the carve-outs. And that's really, again, that's the smallest component of it. It's really that it's your property. You want to manage it. Most lenders, want to see deals that are continuing to move up. So the lenders that did put these lock boxes or these springing lock boxes in place, put it at where the debt service is today, and even gave you some sort of buffer. But people that, again, and some of it's really expenses have gone up. Not necessarily are they mismanaging the property, but as Tariq mentioned, you mentioned, right, expenses have gone up tremendously. And now your cash flow and your NOI is a lot lower than anticipated. Some of those, spring lock boxes will spring, and now all the rent payments and the other income payments will go into the account, and the lender will dole out and pay for expenses. And that's obviously something that, nobody wants.
So we're coming up on time here, so we're going to have to skip a lot of questions. But I'm going to ask one final question. As it's been on a lot of people's minds. It's a general one of, what are the key things somebody should know about the loan? Is it, the LTV, the length, the total origination, who the lender is? Like, in your guys' mind, what are the maybe 5 most important things that investors should look into in regards to the loan?
So I guess the owner can talk about it. I can give you my thoughts, but the owner can tell you what's most important here. But again, just to start it off without counting, you need to know what your business plan is going into the deal, and make sure this lender and this loan, right, addresses all of those. Again, and the loan process, getting that loan, is 30 to 60, 90 days at most, generally. As an owner, you're going to deal with that lender for 3, 5, 7, or 10 years. So although you may bring a lender that has a terrible legal group, right? And people don't necessarily like that. And it's not necessarily something that you really want to work with. But if you look at the big picture and say, this is a lender that addresses my needs, the term is what I need, the prepay is what I need, they're giving me the dollars, the IO, it's the certainty to close. Those are the items that I need to look at. And then also, just as important, I need to deal with that lender. So especially if you're going to take a bridge loan where you're going to have to deal with the asset manager on draws, that's important to have an asset manager and have a lender that has a track record of working with you, right? Maybe on a bank deal, it's not as important because I sit there, I make my payments, the deal's at a minimum, my break even is so much lower than where I'm at. I don't really have to worry about things. I have this deal for 5, 7 years or 10 years. Maybe that's not as important, but definitely in the bridge space or opportunistic or people that are, have a business plan that's unique or different, you need to know that lender is going to work with you throughout the process. But going in, and definitely on my side of the equation, my side of the table, it's making sure that the client's needs are addressed. And sometimes it's right. It can be, it's the prepay oftentimes, the dollars very often. Sometimes it's people don't want the lock boxes are very important, or certain carve out. There are always specifics. Every borrower has different needs for their business plan based on their equity, where the deal is, and what their business plan is. It's making sure it's not just one, it's not a one size fits all. It's not, ultimately when you come to a mortgage broker, you're not looking to go back to the same lender every single time. Although we mentioned having that good relationship is important, but different deals have different needs, and making sure those are addressed are the number one or the only thing that has to be looked at on this deal. All right, Tariq?
Absolutely. It's, understanding your own business plan and knowing what is it that you need. There have been multiple occasions where we have had multiple term sheets from multiple lenders, and there are differences, and we redline the term sheets and send back to the lenders what are you changing, what is important to us as a borrower, as an asset manager, whether it's the prepay, it is the interest only, it is the term of the loan, a lot of those things are important. So as you get a term sheet or a loan application, initially a term sheet, then a loan application from a lender, go through it in detail. Those are the terms that you are going to sign up to in the loan documents. It may be 10, 12, 15 pages long application, but read through it. There are terms that are spelled out in that. There are conditions to income, conditions to other hurdles that are specified in there that you are going to be held to as part of the loan documents. Understand those up front. Understand the approval process and the timeline for the lender. At what point does it really get approved, and at what point the loan sizing is really set in stone. Things may change drastically, but there are exceptions. But in a normal transaction, what is the process? At what point you can lock the interest rate? At what point the loan dollars are essentially firmed up? So understanding that process and how that is going to be approved and run by the lender is critical. The timeline, we have seen in recent months lenders taking longer than what has been typical. We have been used to closing these deals in 60 days, but more recently, they have taken longer, 75, even 90 days. So got to be aware of those things and make sure that you're able to work within those constraints.
Absolutely.
So you guys have done a fantastic job, and I appreciate you guys doing that. We are actually 1 minute over, and so I do want to thank you guys, and for those that hung on the full hour with us, I wanted to pop this up because we are starting a book club starting in 2023. And each month we're going to be picking a new book. And the first one's going to be Rich Dad Poor Dad. So if you want to win a free copy, you can scan the QR code here. And hopefully you guys can actually scan the QR code and our faces aren't blocking it. But if not, we'll sort that out later. But as this slide's sitting up here, Tariq, Mark, any final comments or thoughts you want to share?
I think I'll just end with, obviously, thank you for the opportunity, and it's always good to to speak about the things we do all day. But opportunities will come. Opportunities, there's always an opportunity, as you said from Warren Buffett, right? Yeah. There's always a time for somebody to make money, and you just got to position yourself to be there. Figure out what your game plan is, whether you're a seasoned owner or just starting out. Look at what I want to do and try to really set up your full team. Obviously, it's difficult to do that, but understand what your game plan is and be ready that when the opportunities do come up, you can act quickly and try to move the process along as quick as possible, because especially in a volatile environment, any seller is going to want certainty to close. It's high up on the list of probably any seller. So, be ready to have everything there that, the broker or the seller can see that you're going to close, you're going to make this deal happen, and just, try to be creative in the process, and, just as, figure out what it is that you need, as we just discussed about, understanding a lender, what's the business plan that I generally want? Obviously, every deal can be something different, but what's the business plan I want? What's the market? Where do I want to be? And, just enjoy the process. And, I think 2023 will, bring opportunities for some. Unfortunately, will, bring downfall possibly for some others, but just be ready. And hopefully we enjoy the holiday season now and start 23 on, the right foot.
Right, I'll just say that you got to be cautious in the times that we're going through. Be cautious, but when there is an opportunity, the ability to move quickly is going to be critical. So that just prepare yourself for that and be able to move quickly when there's an opportunity. But be cautious. These are very volatile times that we are going through.
Absolutely. Again, it's all right to just look at other people's underwriting or to just trust, what some guru told you or some, podcast you may have listened to, maybe this one is not necessarily always, I'm not saying it's inaccurate, but you need to look at every deal and underwrite it properly and really understand the comps of where rents can go and what the specifics are in this market. And, oftentimes historically, and Tariq, you can, attest to this, if you go through an OM, the comps, there's like a creative marketing team to try to sell you on comps that really are not comps. It can be 4 miles away, or it'll be 10 years older. They'll just write renovated and to try to sell you something. So really understand the deals, understand you're getting into works today for what you need, and you have a business plan, an exit plan, and hopefully we all seize the opportunities that will come up and make some good money and, do right for our investors and, have a good place for people to live.
And on the lending side, the one thing I will add, just based on experience, we have done, quite a few loans now in both the, Fannie, Freddie agency space, bridge loans, bank loans, credit union loans. We have dealt directly with the lenders on some of them, and we have dealt with done the loans through a broker on a majority of them. Having had all of those experiences, have someone to fight for you as a borrower on your behalf, have a broker, pay that cost. It is critical. It could have such a huge impact in the loan sizing and in the process being run in your favor versus not.
Absolutely. I can give you advice. Yes. Yeah. But it is, again, forgetting using Mark Steele and just the broker. Brokers deal with lenders, that same lender. Yeah, you may be an active buyer and do 3 or 4 or 5 deals a year. And assuming you even do it with the same lender, but that's 5 deals. The office of Meridian, that just taking as a firm, Meridian does 4,500 transactions every year. The firm does 60, or last year did 60 billion, and this year will exceed that. So as a firm, the leverage, it's not necessarily even myself, it's the people that I work with, the relationships we have can, yield you a better deal. And hopefully our team, I can work with, and any broker can, in their own organization, could look at and find, the right team and the right lender for your specific deal and have that relationship with a lender that they talk to probably daily and be able to bring you the best deal, and the cost on the other end is minimal to the value that I think, mortgage brokers bring in. And that's probably really in any industry and anything. Having an expert that does this all day will bring you results that are worth generally worth the cost.
Amen. Amen, guys. Amen. Hey, Mark, Tariq, thank you guys so much for shedding all that knowledge for us in this last hour, and apologize to those that we ran a bit over, but hopefully it was well worth it for you all. If you want to join us in January, third Wednesday of January, 7 p.m. Central, we'll be talking about a new topic based on the questions that you guys email us. And then once again, as a reminder, if you want to join the book club, Rich Dad Poor Dad, first one starting in January. So thank you so much, everybody. Happy holidays. Wish you a great evening. We'll talk to you in 2023. Have a good night.
Thank you. Enjoy. Take care.